The biggest reason that most traders fail is because they don't understand market structure in the way I'm going to share with you today. If you watch this video until the end, you will have all the keys to become a successful trader. I've broken this course down into 3 parts. And in those 3 parts, I've broken those down into 2 parts each. So this is a 6-part course, and each part is equally important. Take your time to watch everything slowly and remember to take note. And if you watch this full video to the end, I'll be giving a free gift out to show my appreciation. Okay, so here we are, and we're starting off in part 1, which is simple structure. Now, there's simple structure expectation, and then there's simple structure reality. Let's go through each one conceptually and then take them over to the chart. Starting on the expectation. Now, typically speaking, when you see structure or you see structure videos out there or these textbooks or anything of that nature, you typically see things, in this essentially expectation, which is to say that price just continually makes higher highs, higher lows, and it looks so pretty and so simple. Same for bearish. Price just makes a series of lower lows, lower highs, and it's just so easy and so simple. Now, very rarely does market structure ever actually look like this. In fact, you're more likely to get something that looks like this. Now, this is simple structure. It's still simple, and I'll make it simple for you, but it may look a little bit complex. So let's break it down step by step. Low to high. This low and this high is simply our current trading range. And then what you see is the pullback phase. So imagine price is bullish right now. We've just had a break of structure. Now we're coming for our pullback. Likely what you'll see is a series of internal pullbacks that look something like this. And then you will have the realignment internally before eventually breaking structure. Now, the biggest question that I get is, how do we know which one is swing structure? How do we know this isn't swing structure? And then we become bearish. It's simple. The move that is the external low that puts in the external high is your swing structure. Everything else in between is internal structure. So again, the final low before price shifts and puts in the high. Now, here's where it gets interesting. A lot of people see this low, we put in this high, we pull back, and then we go higher high. A lot of people think and make the mistake of using this low as their structural low. But this isn't, because we haven't yet broken structure. So this is the key low. This is our strong institutional low that actually caused the break of structure. Now, let me give you a scenario where this would be different. If this low had first broken structure and then pulled back and then broken structure again, then you would have a new low. You would have a new structural range. But because price didn't break structure and then pulled back, it's all part of one structural range. And that's why sometimes people can get confused, is because you can have a really large trading range and then you can have a really small trading range. Like this, you have a low down here and a high up here. That's your trading range. But then price could literally just pull back and put in a new high like this, and then you have a new, much smaller trading range. So don't let this one thing confuse you. Moving on to a bearish scenario, which is simply just the same, but in a bearish scenario. You can see essentially, let's say we're bearish, price is put in a break of structure to the downside. We have a low, a high, a lower low, so price is bearish. And then the pullback typically looks complicated because we have a bunch of these internal highs and lows. Price comes down, and then eventually we break structure. But remember, it's the highest external point that is your structural high. And then the low after we break is the structural low. And then when price pulls back and puts in a new break of structure, you have a new trading range. So that's typically what, simple structure is going to look like realistically. So if we go now up to the charts on GBP USD and we take a look at, what this looks like from an actual mechanical perspective. Well, let's start up here and say this is our trading high. So if we just mark out this as our swing high, that's our trading range. And then price puts in this low right here, which is our trading range. Price then pulls back. But notice it doesn't just come back and then go lower. It actually has a series of these internal structure points. And the issue is many people think that these become their new structure, but it isn't. You're trading inside of a structural range. It's this high up here to this low down here. Anything in between that is what we call internal structure. And it's internal structure because it's structure internally of the swing structure. And so once we break structure to the downside, now we have a new trading range. And our new trading range comes from the high and the low of the new trading structure. And then what happens? Price pulls back like this. And what happens right here is many people make the mistake because they believe that once we make this low, we pull back, we put a new lower low in, this is our change of character, but it isn't, because our trading range is this high to this low. And so this is one of the biggest mistakes I see traders make when it comes to market structure. From there, we put in a high, a low, high, a low, and a high. What you can see is we create equal highs and equal lows across the board. So typically when price creates a pool of liquidity on each side of the market, it's going to run one side of the market and then run the other, because there are a bunch of liquidity down here in the form of stop losses and sell stops. There are traders waiting for this breakout so they can go short. And there are also traders who are looking at this as an area of support. And so they're waiting for the third touch to go long, and they get tagged into their long and they put their stop losses below here. And that's why price purposefully moves in such an aggressive manner into this entire liquidity pool. And now once it's taken out that area of liquidity, the only liquidity remaining is on the buy side. We have this pool of liquidity right here. So price has to run and go and tap into that pool of liquidity right there. And that is where we get our first phase of trend reversal. Because from here, price puts in a lower low. From there, price goes and puts in a higher high. So that is our change of character. And again, a huge mistake that I see traders make on a daily basis is that they think this right here is their structural high, but it isn't, because until price breaks this low right here, we're still in a range. So we need to use the most external high that there is inside of the previous range as our new trading range. And so the issue that there is with this is for the traders that would have potentially considered this as their high, well, now what is very possible to have gone and happened is price to run the high, mitigate this area of supply, and then go lower. And all of a sudden they got trapped on the wrong side of the markets because they thought they were supposed to go long, when in actuality, until the highs had been broken, they were still supposed to be going short. So after we have our change of character, which is right here, the high that put in the low gets broken, now we essentially ascend and have our bullish structure. And you can see price pulls back. And this is where, you know, in a scenario that structure does look simple. And sometimes you'll get this, but your philosophy should stay the same. Your rules should stay the same. Whether simple or complicated, the rules stay the same. So you can read it the same way. Because in this scenario, it's very simple. We put in a high, we come back, higher high, higher low, higher high, higher low, and then price goes and puts in a new higher high. So that is an example of, you know, the expectational structure, which you typically see in textbooks, which very rarely occurs, versus your basic simple market structure in reality, which is a lot more confusing and choppy. But if you have a set rules to trade this market structure, then it should just be as simple as basic market structure, because your job is just to follow your rules. Okay, now we're into part 2. The 3 types of structure. Again, this is something I see many traders get confused with, or in fact, they just don't know this concept at all. And that's what leads to most of their mistakes with structure. Now, what we have right here is a bullish example. So let's say price just put in a high and we just broke it. So we have a break of structure right here. We have our trading range, which we now understand to be this low right here and this high up here. So as we know, the likelihood is that the price is going to make a series of lower lows internally. And we actually call this internal structure our order flow. Order flow essentially represents the present flow of orders in the market. So this can be sometimes understood as our lower time frame, which we'll get into in the next section. So our order flow makes a low, it makes a lower high, a lower low. So at this point, when your order flow becomes bearish inside of a bullish external structure, we simply just come in for a pullback. So that's a clear indication that price is pulling back. So price makes a series of lower highs, lower lows, lower highs, and lower lows. Now, typically, if you add in the element of supply and demand, usually price will get into a higher time frame area of demand, which is what we mapped out here in gray. And then from there, we'll essentially see an order flow realignment. An order flow realignment is where the order flow realigns with the directional structure. In this case, bullish is what we have for our directional structure. And then we have bearish order flow until we realign and we make a higher high instead of a new lower low. This is such an important model because this is our entry model. This is essentially what we're going to be using when price gets into a higher time frame point of interest to have a shift to go higher. And so the area of demand that causes that order flow realignment is where we're going to be looking to take our entries, taking out the external high. And again, something that people get mixed up with a lot of the time is understanding what's order flow and what is structure. So we have right here our structural range. So anything inside of this high and this low until it breaks either one of the two sides is just internal. It's that simple. And so here we have our order flow making lower lows, lower highs, lower lows, and then higher high. This order flow realignment is our change of character internal. So it's an internal change of character that gives us our order flow realignment. From there, we go order flow break of structure. So an order flow realigned break, which essentially is just a continuation inside. So once you see this, what you can then presume is that this right here is a weak high. And essentially from there, we're going to go and run it. And that's exactly what we do. Now we move into part 2 of step 2, which is understanding this concept on the charts themselves. So here we are again, same price action. I don't want to confuse you. Let's use the same price action to teach everything. What we can see is we have our low down here and our high up here. That right there is our trading range. Let's be a little bit more professional and use the trend tool. We have our low right here and our high. So this is our current trading range. So what happens is price puts in essentially this low, it puts in this high, and then it puts in a high, then it puts in a low, and then it puts in a new high. Now, what do you see? Those right there are our internal structure. So if we mark this out as essentially low, high, let's change the color for this so we can make it very clear. Let's go purple. Low, high, low, high, low, and then high. Now what happens is price shifts. Price goes low, high. So on this new low, you can see what we've done. We've broke the internal low. So that right there is our order flow realignment, our internal change of character. Why? Because that clearly tells us and represents to us that we have now shifted from going internally high and pulling back to what? Internally lower lows. So at that point, it's confirmed that this low down here is going to be taken out. And what happens? That's exactly what happens. We now have a new lower low. And notice if you actually map out your trading range, right, this area of supply right here, what happens? Price taps just into the area of supply before taking the lower low. And so that's the exact same thing that we just explained conceptually down below. So now what we have is internal is bearish. We have lower low, lower high, lower low. And then what happens? Price goes and makes a higher high internally. So what we've had is an internal order flow break. And essentially this order flow break is indicative of a pullback on our present trading range. We have our high up here and we have our low down here. This high and this low is our present trading range. So what happens is when we have that order flow break back up, we understand that we are now coming for a pullback. Very important. And again, if you pull out the area of supply that we have sat right here, well, that's exactly where price taps into. And then what happens? Price comes back down, taps into this area of demand right here, which is why it holds. Then price comes back up, takes out areas of internal liquidity, comes back up, mitigates ranges of supply, wicks through them, collecting liquidity, comes back down, and once again respects areas of demand. And what does that do in the process? Let's take a look at that. We have one low, two lows, three lows consecutively, which as you know, SMC traders, we understand that patterns get artificially created in order to create liquidity. So that's exactly what price has done right here. Price has built up a bunch of liquidity on the sell side, because what are you taught? If you're a retail trader, you're taught the first tap, no. The second tap, okay, now we have an area of resistance. So on the third tap, we're going long. And so what happens? The third tap comes, we have the push off. And what happens is the people that didn't get in right here, right, when they see this reaction and they see price making highs like this, they're getting in a hole along the way. That is essentially psychological liquidity inducement. And so from there, what happens? No surprise that price taps into areas of supply and then melts off through all of the stop losses. And in fact, if you just notice right here, look how impulsive the specific candle that runs through the liquidity is. There is no wicks on it. What does that mean? Look how impulsive it is. Well, what does that give opportunity for? Slippage. Because price was so aggressive into stop losses and into orders, it will have likely taken traders out at areas they didn't want to be taken out at, or tagged them in areas they didn't want to be tagged in, causing what? More liquidity and essentially more money for the brokers. And so after price runs into the pool of liquidity down here, well, now what do you have? All of the buyers are out of the market. So all we have now are all the sellers who just got tagged in positions. The same sellers that are looking at this right here as a double top, and we're waiting for price to come back up, test it again, and then go. But what happened is they seen the momentum run into the downside, and also a bunch of the breakout traders that were breaking the lows and looking to short. Well, a bunch of traders are looking with so much momentum. FOMO. This is where FOMO comes in, and a bunch of other things that people just force into positions. So once all the longs are taken out, all the buyers are taken out, and all the sellers are in, well, now where is the liquidity? The liquidity only exists now for the sellers. So all of the stop losses, all of the new orders are up here. So we have relatively equal highs up here. We have clear equal highs up here. We have the breakout traders who put their stops up here or up here. So all of the liquidity now exists on the buy side. So there is no surprise then that when price has done what it wants to do, and we have a bunch of built up liquidity in here, price goes and seeks the next pool of liquidity, because that's all the purpose of this market is. It's essentially to create and collect liquidity. And so many retail traders think of this and they think of the market's out to get me. They have the victim mentality of the market's out to get me. The market makers knew where my stop loss was. No, it's just simple. It's just a liquidity algorithm. The algorithm is designed to go and collect the most orders at where they exist. And unfortunately, the industry has essentially created so many of the same traders, because if you go to all the brokers and all the free information out there, they're all going to teach you the same things. And so what does that do? That's what creates all the liquidity. So it's not that the market is out to get you. It's just that you're on the wrong side of the market. You don't understand the market for what it actually is. And so from there, what happens? We've run into liquidity, and now the trend has shifted. We have higher highs, higher lows, higher highs, higher lows, and higher highs. And if we was to go deeply into the lower time frames of this right here, let's break it down. We would essentially see high, low, high, high, higher low, higher high, higher low, higher high as our internal structure. So you can see essentially after price does what? High, low, high, high. After we shift internally here, that's our pullback. And then what do? We realign for our extension. Pull back, high, high, mitigate area of demand, and then continue. And so here's another thing. Look at how we go from such a large trading range, right? If we look at, let's take this high and this low, that's how large that trading range is. You have all of this. And then we go from this low to this high. Look at how small this trading range is compared to this. And that's one of the things that most traders get caught up on, is they don't understand. They're thinking, how can one trading range be so much larger than another? And it's simple. If you have rules, the rules dictate what the market is saying, because the market and the data and the candlesticks, they just tell a story. Okay, and now into the final part of this 3-part course, multi-dimensional structure. Something I see so many people get wrong, and I'm here now to show you how to do it correctly. So as you can see, we have purple line, and the purple line is going to represent our 4-hour structure. And our green line is going to represent our 15-minute structure. So what we can see is the purple is making a series of lows, lower highs, lower lows, lower lows, lower highs, lower lows, lower highs, and lower lows. So purple equals bearish, which means 4 hour equals bearish. Then if we take a look at the green, we'll see that the green shifts from bearish to bullish, from bearish to bullish, from bearish to bullish on multiple different occasions. So how do we make sense of this and put it into our plan? Simple. So we understand now that if we take our high right here and our low right here, that is essentially our trading range. So what happens is on the way down, the same 4 hour is perceived in the 15-minute as a series of lower lows, lower highs, lower lows, lower highs, and lower lows. Eventually, at some point when price puts in a new lower low, internal structure is going to shift from bearish to bullish, which is our change of character. We've gone from bearish internally to bullish internally. And what that simply means is that the internal structure shifting bullish means the external structure, our 4 hour, our purple structure, has come for a pullback. Now, in this pullback phase, typically what will happen is price will make its way up to an area of supply. And that's exactly what happens. So then the internal structure makes a series of higher highs, higher lows, and higher highs. It taps into an area of supply, and then it does what? It starts making indecisive price moves. Price comes down, it respects the low, so you're expecting it to go higher. But then price comes up and respects the high. And so now you're caught in a fight between supply and demand. And it's in these scenarios where you sit on your hands, you wait for the market to show you what it wants to do. And in this case, if you've done that, you will see that price makes a change of character. So when price makes this change of character, we can now get involved in the market. We understand that 15-minute is bearish, so is the 4 hour. So what's next? Price is going to move and take out the 4 hour low down here. So we shift character, we pull back, and we put in a new lower low. In doing so, we break structure on the 4 hour time frame. After we break structure on the 4 hour time frame, what do we have? We have a new structural range. We have from this high up here to this low right here. That's our new structural range. Remember, anything in between this high and this low is just internal. So if we map out our internal again, what do we have? We have lower low, lower high, lower low, higher high, change of character. Right there, price changes character, goes from bearish to bullish internally on the 15-minute time frame. From there, it comes back and goes bullish again. We break structure, higher high, we tap into a higher time frame area of supply, and then we get our change of character, where the internal 15-minute green shifts from bullish, pullback to 4 hour, to bearish, realignment to 4 hour. The moment this realignment takes place, we know now that this low right here is being taken out. Same thing happens time and time again. 15-minute continues lower, lower low, lower high, lower low, higher high, change of character. What's price doing? Price is coming for a pullback from our new structural range from this high. Mitigates areas of supply, shifts from bullish internally to bearish internally, mitigates area of supply, and we take out the 4 hour low down here. And that is how to really understand multi-dimensional market structure. And so now let's take part 2 of this and go into the charts and apply multi-dimensional structure to the charts themselves. So what we're going to do here is we're essentially going to, let's go from high to low to high to low. So we've mapped out these trading ranges. Now we understand, and we're going to map out like this: 4 hour high, 4 hour low, 4 hour high, 4 hour low. So these right here are essentially our 4 hour structural ranges. And you can see price makes lower lows, so price is bearish. But if we go and perceive these same structural ranges on a 15-minute time frame, we will understand the ebbs and flows of the market structure. So now if we go into part 2 and we take multi-dimensional market structure from concept to practice, this is what it's going to look like. So here we are, 4 hour time frame, GU, same price action, nothing's changed. And we're going to be taking a look into this price leg right here on the 4 hour time frame. So what you can see is price changes character, pulls back, break structure, pulls back, break structure, pulls back, break structure. So we've mapped out here in green our 4-hour swing points. We're going to go and dive into these 4-hour swing points and understand what takes place in the 15-minute to indicate whether or not price is pulling back or going to be extending and taking out the highs. Let's drop into the 15-minute. So let's make our way down to essentially point number 1. We can't really understand this because this is where price goes from, bearish to bullish. So it's essentially unexpected. But what happens is as price breaks the highs, if we put the high up in here, we can still map out our 15-minute structure. Because if we have on the 15-minute, we have low, we have high, we have low, we have higher high, higher low, and then essentially higher high, higher low, and then higher high. So the present trading range when price takes out the high is the low in here and the high in here. So what happens here is this is not a breakout structure. This is a liquidation. When price only liquidates the high, meaning wicks above the high, that is simply just a liquidation. So we've liquidated the highs, perfect. And we have our low and our high. So in theory, we're expecting price to make a higher high. And so that's what we're waiting for. We're waiting for price to essentially mitigate this area of demand and go and make a higher high. But if it doesn't do that and it makes a lower low, that's indicative of a 4-hour pullback. So if we just slide to the left, what do we see? We see after ranging for a long period of time, because essentially what happens is if price is sat in a price range for a long period of time, it's usually one of two reasons. Number one, low liquidity. It means there's not much going on. Or number two, a loading of orders. And so typically what you'll see in a range is if there's a huge move that comes after, it was a load of orders that were being built up in this area. So eventually price actually changes character to the downside. What do? We break the low that put in the high. That's our change of character. So now we're expecting a 4-hour pullback. So what happens? Price essentially creates a lower low, pulls back, and then lower low. So at this point, we understand if we look at the price leg from the 4-hour, price has started pulling back. We've put in a high, we've pulled back. Now, essentially, price on the 15-minute is going to continue being bearish for as long as it wants to, for as deep into the 15-minute price leg as it wants to, until eventually it realigns. And it's going to realign by taking out and having a change of character once again. So we understand that now we have bearish price action on the 15-minute, and our trading range is the high up in here to the low down here. So we're waiting for one of two things. Either the lows are going to go and we're going to continue trading short, or the highs are going to go. And if the highs go, then that means these highs are also going to go. So what happens is price pulls up, liquidates the highs, doesn't break them, or even creates, perfectly equal highs even, which is, of course, as we know, liquidity. And then price does what? Changes character. So price actually breaks the high, changes character. So we can now confirm that these highs up here are going to be taken out. That's pretty much confirmed with a high probability. Now, as I mentioned before, this is not our structural low because nothing happened. Price was not broken structure before. This was our structural low that caused this structural high up here. Pretty large trading range. And then price pulls back into here before going higher high again. And so look how you have essentially from this low to this high, then pull back from here to here. It's a smaller trading range. And from there, what does price do? Price pulls back into an area of demand and then takes out our higher high. So right now we have bullish 15-minute inside of bullish 4-hour. So essentially all we're expecting is for price to go and run this high up here, which is our target. So 15-minute does exactly that. Essentially we put in a low, lower high, no, high, higher low, higher high. We don't understand essentially whether this was a break structure or not because there's no body. So that's just a gap up. So this is the high, this is the low of the trading range. Price pulls back, puts in what? A new higher high. The new higher high is from, we break here, this doesn't meet the criteria for a pullback, higher high, higher low, this does meet the criteria. And then once again, higher high. So now we're currently in the trading range that is from the green down here to the green up here. So we're either waiting for one of two things. Number one, price is just going to continue going higher and we'll look for continuation longs. Or if price does break structure and change character as it does right here, that simply just means that the 4-hour time frame, right, which is our low down here, is simply just coming for a pullback. And so if we dive in, you'll quickly see that, of course, price does change character to the downside. This change of character to the downside is essentially our indication that price is going to come lower. We break, we change character, we pull back, once again, we go lower low. And so from here, it's one of two things going to happen. Either we're going to respect the highs and go lower and pull deeper into the 4-hour leg, or we're going to change and realign. It's that simple. And so essentially what happens is price does change character on the 15-minute time frame, which tells us what? That these highs are going to be taken. And that's exactly what goes and happens. The highs get taken. Now we have our internal and our external both as the same trading range, which can sometimes happen. So we have the lows down here and the highs up in here. And then the lows, and then essentially price is going to be pulling back into something, creating higher highs again, pulling back, higher highs again. Until eventually the 15-minute goes from bullish back to bearish, which simply means a 4-hour pullback. And so that is how to understand multi-dimensional market structure, understanding the structure within the structure. And essentially you're able to then go deeper into the 1-minute time frame, for example, and take your entries. Congratulations if you made it to the end of this video. This tells me you're a serious trader and you're looking to grow your trading skills. If you're interested in working alongside me and the team, there's a link down below to register for a call to see whether or not you're a good fit for us.